Hello, and welcome to the latest edition of Edison TV. Today, we are delighted to be joined by Jon Bunting, CEO of Smiths News, the UK's largest newspaper and magazine wholesaler, with a market share of 55%. Welcome, Jon. Great to see you, and thanks for joining us.
No problem.
To kick off, let's discuss your recent contract renewals. Over the last 4 months, Smiths News has signed 4 major long-term contracts with newspaper and magazine publishers that cover approximately 46% of newspaper and magazine revenues up to 2029. How were you able to reach agreements so far ahead of the expiry of the existing contracts?
Yeah, no, good question. So firstly, we're delighted that we have been able to do so. So as you say, we've got 46% of our revenues now secured until at least 2029. Many actually go through to 2030. I guess it's the ultimate vote of confidence, isn't it, in the service you're providing, in the relationship you have when your clients are prepared to sign new long-term contracts. And particularly because we've managed to secure better terms through the contract process. So I think it's worked for both parties for 2 reasons. I think from a client perspective, so from the publisher perspective, signing early with us means that they have clear visibility of their costs, of their route to market now through for the next 6 or 7 years, depending on the individual publisher. And that's important for them in terms of how they think about their business going forward. And for us, it's important because it enables us to have a good visibility of our cash flows, which are an important part of our business model in terms of our dividend payments, et cetera, but also because it enables us to think more broadly about the business, about what we want to invest in to strengthen the business further, and how we continue to bring down debt and reward our shareholders. So I think, yeah, we're delighted that we've managed to get the contracts done, but it's only possible, I think, because of the strong nature of relationships and service that we provide to our clients.
Great. And following on from that, now that these major renewals have been agreed upon, what scope is there for other publishing groups to renew long-term deals to secure services?
Yeah, I mean, we are in discussions with a number of other publisher clients as well. Those conversations are going well, but they'll operate at their own pace as individual businesses have their own rhythm and beat as to how they like to renegotiate contracts. But I'd be disappointed if we were not able to conclude at least one of those over the next few weeks and months. I mean, I think the key thing is all of our conversations with our publisher clients are going well. So we've got a high degree of confidence that we'll reach conclusions that work for both our publisher clients and for ourselves. But like I say, it just takes a little longer with some publishers than others just because of how they like to do business.
And moving on to ancillary revenue development, given the long-term characteristics of the newspaper and magazine industry, how important is the development of ancillary revenue? And do you think that there is scope for this income to completely offset the decline in contribution from core profitability?
Yeah, I mean, I think that's really the critical question, Natalia. So, I mean, let's look at our markets first of all. So they are large markets, but they are in structural decline. But we shouldn't over egg the pudding in terms of how quickly they are declining. Over 20 million consumers still read a newspaper each month, over 20 million still read a magazine each month. So they're large markets, but they're in decline. They're in decline for the obvious reasons of the transition to digital, but also because you've seen a generational shift. You see very few teenagers now reading a newspaper or magazine in the way that you once would have done. So we know that. But what it means is because it's a relatively slow decline, we can be careful, thoughtful, considered in the way in which we look for new profit streams, which is what we've been doing over the last 12 months. So I think we've found 4 or 5 really interesting areas of potential growth for the business. We're testing them currently. Talk a bit more about that shortly, no doubt. Do they have the potential to offset our profit exposure from a declining newspaper and magazine market? Yes, they do. But it's potential right now rather than proven. And so, yeah, perhaps we talk a bit more about those if that's helpful.
Yeah, so in terms of leveraging adjacent opportunities, so far Smiths News has identified 5 initiatives to achieve low risk, low capital expansion in service expansion, logistics services, supply chain integration, direct to consumer, and categories and data. Could you briefly describe one or two of these initiatives to give a flavour of their nature and potential?
Sure. So we are pursuing a strategy which we call enhance the core, add more, and move up the value chain. And this is all about leveraging our proven capabilities, skills, and assets in the business, rather than looking at something from a pure play diversification. So we're not looking at new sectors and new skills. We're very much looking to do more of what we're good at. We talk about enhancing the core because actually our news and magazine business is a large, robust business that throws off lots of cash and enables us to do all the things we want to do for the various stakeholders. And we don't want to be in a position where by pursuing growth in any way, we neglect that. That would be the wrong thing to do for all of our stakeholders, we believe. So we're very focused right up front in saying enhance the core. But we're really clear that we can add more and we can move up the value chain. So if I give you an example of adding more, one of the things we tested last year was Smith's News Recycle, a simple concept where we collect the unwanted cardboard and plastic from our retail customers at the same time that we're collecting their unsold newspapers and magazines, bring them back to our distribution centres, and we put them through the same recycle supply chain that we have for newspapers and magazines. We tested it last year. It's tested really well, and now we're currently rolling that out across our entire network. And we've gone from having a small number of customers live in the test phase to over 1,000 customers live as we sit here talking today. So we believe that that has definitely got potential, and it's tapping into the ever-growing market of recycle, as I'm sure you're aware. The second one is very different again. So you've heard me talk about the fact there's been a transition and continues to be a transition from print to digital. And so from a direct consumer perspective, we've launched a business called Love Media. You will have heard me talk about it at the end of the year, in November last year, where it was called My Mags. We've rebranded that to Love Media because we think it's broader than just magazines. And what this enables us to do is to provide a solution for our publisher clients and our retail customers, both large and small, to provide a digital solution. So if you walk into your local newsagent or supermarket or petrol forecourt and you want to buy a particular newspaper or magazine, and for whatever reason, either you want to buy it digitally or it's not there to buy physically, you can simply scan a QR code with a Love Media branding, and it'll take you directly to our landing page where you can download the digital copy of that newspaper or magazine. So yeah, it's a really good example, I think, of us again leveraging the relationships we have both with our publisher clients and our retail customers to provide new solutions, but also being mindful of the fact that we can now offer a blended solution to our retail customers and publisher clients at both a physical route to market and a digital route to market. Now, the big difference between the Love Media solution and others in the marketplace is that ours is a pay-as-you-go model. And by that, I mean, it's not a monthly subscription or an annual subscription. You simply pay for the title that you are downloading at that point. And if you only ever buy one title, that's all you pay for. But it's a pay-as-you-go model, which is much more in keeping, I think, in terms of how people are thinking about spending in the current economic climate.
And now moving on to cost inflation management. It's been well publicised that inflation in both energy and wages has been a feature of the last 12 months.
Yeah.
Given that Smith's News has been driving efficiencies out of the operations for years, how has the business been able to manage these pressures successfully?
Well, you've partly answered the question yourself there, in as much as we have got a proven track record of taking cost out of the business. And that comes through both detailed understanding of our processes and how they fluctuate according to volume demand. But it also is partly cultural, and the fact that in the business people don't look to spend money they don't need to spend, and they're constantly looking at ways to innovate to make the business more efficient. So I think we are really pleased actually with the progress we've been making in terms of inflationary pressures. We said at our AGM in January that we're currently trading on plan, and we are. Yeah, there is no reason to believe that will change over the coming months. So it's a combination, therefore, of understanding our business well, having a culture that focuses on costs, and having really engaged team members. So our engagement scores in the business are high, at the highest they've been for over a decade. So, there are lots of reasons why you work for a business. One is financial, but sometimes it's more than that. Sometimes it's about how the business treats you, whether it's a good place to work, et cetera, et cetera. So we like to think we're trying to address all of those things. And by having a combination of those things, we're a good place to work, even if we're not always the most attractive place to work financially.
And Jon, you were appointed CEO of Smiths News in June 2020. How would you describe the future direction of the business now compared to what you were thinking at that time?
Yeah, really good question. So for me, decision-making is always situational. Our situation at that time was that we had a materially underperforming part of the business. We had a share price of a low of 11p. We'd lost the confidence of our stakeholders, not only our shareholders, but I think our banks too. And a number of colleagues were wondering where the business was going. So it was a real crossroads, a real low for the business. So we said right at the outset, the only way we can move forward at this point in time is to start to rebuild the trust of our key stakeholders. And the only way we can rebuild trust is by being very transparent about what we're going to do and the targets we're setting for the business, and then delivering against those, being very focused, not being ridiculously ambitious, but saying, look, we've got some stuff we need to do here. So we disposed of the underperforming business. We renegotiated our banking agreements. We put in place long-term contracts with our publisher clients, and we've continually at least matched, if not exceeded, the financial expectations that the market had for this business. All of that means that 3 years on, our share price in January was nearly 60p. It's dropped a little bit since then, but it was nearly 60p in January. We've made material strides in bringing down our debt. We've got, I think, a more engaged shareholder base now, who are starting to regain trust in this business and the management team. And we've got engaged staff and clearly very satisfied clients because of the nature of the long-term contracts we're signing. That now enables us to be sensibly ambitious. And by that, I mean, we can start to think about growth in the way that I've talked about. We might even start to think about small acquisitions at some point in the future. But what we won't do is put at risk all the great work we've done over the last 3 years on to improve the balance sheet. So for us now, it's about being sensibly ambitious. And that just wasn't possible 3 years ago.
And now let's discuss the dividend. So the yield on Smiths News shares at a 50p share price is very attractive, 8.4%. The yield is in fact so high that it might suggest to some investors that it is about to be cut. What reassurance can you give to investors that Smiths News is willing and able to pay a dividend at this level?
Yeah, well, in terms of our ability to pay a dividend, that will always come down to trading, and clearly we're on plan currently. We have no plans to cut the dividend at all. So subject to trading, then the 10 million dividend will remain in place, but it is subject to trading, clearly.
And to finish off, let's discuss any potential for dividend expansion. Smiths is limited by its banking agreements to a maximum dividend payment in any year of 10 mil, i.e. 4.2 pence per share. However, the business has generated earnings per share of over 10 pence per share in each of the last 2 years, implying a healthy dividend cover. Under what circumstances could the dividend be raised in excess of the current 10 mil per annum total?
Yeah, so the 10 million cap currently is as a consequence of our banking arrangements. So we throw off circa £20 million worth of free cash, between 20 and 25, depending on the year. Around half of that we put towards our dividends and to our shareholders. About half of it goes towards paying down debt, and the balance is actually investing in the business and making sure we remain the market leader that we are in our markets. So for us to change that, it would require us to change our banking agreement, which are not up for renewal until 2025. Now, we have good relationships with our banks. We're constantly in dialogue with them. If it makes sense for us to change that at some point in time, for both our lenders and for ourselves, then clearly we'll consider it. But in the short term, the 10 million cap is there as a consequence of our current banking facility.
Well, thank you so much, Jon, for your time.
No, thank you, Natalia. Very much appreciated it.